Hello everyone, welcome back to Money Gist Top 5. I'm Oluyemisi Dada. The Central Bank of Nigeria has released its very first CBN Fintech Report, and it's all about shaping the future of fintech in Nigeria with innovation, inclusion and integrity at the center. Now, this report is the most detailed breakdown yet of Nigeria's fintech ecosystem. It looks at what's working, where the opportunities are, and the key reforms needed to keep innovation growing without putting financial stability or consumer trust at risk. According to the CBN, fintech is not competing with banks. Instead, it's a complementary pillar of the financial system, helping to drive inclusion, efficiency, and long-term economic growth. The report was built from wide stakeholder engagement, including nationwide survey of fintech operators, a technical workshop last June, and a fintech roundtable held in October. It also places Nigeria's fintech journey in a global context, showing where the country is learning from others and where it's leading Africa. One big highlight, nearly 11 billion transactions went through the NIBSS, that's NIBS instant payment platform in 2024, up from just 5 billion in 2022, putting Nigeria among the world's top real-time payments markets. Still, challenges remain, from regulatory clarity to compliance costs and cross-border expansion. To fix this, the CBN is pushing for clearer rules, stronger digital infrastructure, better regulator industry engagement, and tighter system integrity. The main gist is, this report is meant to guide regulators, fintechs, investors, and partners towards a more trusted and globally competitive digital finance ecosystem. Despite loud complaints from local refineries about crude oil shortages, new data shows Nigeria has been exporting most of the oil it produces. The figures from the Central Bank of Nigeria shows that between January and October last year, Nigeria exported about 306 million barrels of crude oil. During the same period, total crude production stood at roughly 443 million barrels, averaging about 1.45 million barrels per day. That means nearly 70% of Nigeria's crude output was exported, leaving just about 137 million barrels for local use. And this is where the problem lies. Major refiners, including the Dangote refinery, say they still can't get enough crude locally, despite the domestic crude supply policy and even the Naira for crude arrangement. As a result, Dangote has had to import crude from the United States, Ghana, and other African countries just to keep operations running. Modular refineries are also feeling the heat. According to the Crude Oil Refiners Association of Nigeria, some modular refineries operate at as low as 10% capacity, while others shut down completely for months due to lack of feedstock. So, is Nigeria not producing enough oil? Not exactly. Experts and refiners say the real issue is priority. Although the Petroleum Industry Act requires oil producers to supply crude locally before exporting, refiners say the system is weakened by the willing buyer, willing seller model. In simple terms, upstream producers prefer selling abroad because exports bring in dollar payments, which are more attractive than selling locally. Local refiners dealing with Naira volatility and limited access to forex often can't compete on price. Regulators insist crude is being offered locally, but refiners argue pricing, crude quality, and inconsistent supply make it impractical. The main gist here is that Nigeria produces enough crude to meet both local and export needs, but its oil strategy still leans heavily towards foreign exchange earnings, leaving domestic refineries struggling. Energy experts are now calling on the federal government to truly prioritize local refining if Nigeria wants energy security, lower fuel imports, and stronger industrial growth. Nigeria's state government and the Federal Capital Territory have received a total of 2.45 trillion naira from the federal government for infrastructure and security projects. Official records from the Office of the Accountant General of the Federation show that the funds were disbursed over 17 months, from March 2024 to August 2025. The money came from non-oil revenue savings under a special intervention program designed to ease financial pressure on states and fast-track development projects at the grassroots. In 2024 alone, states received about 1.18 trillion naira, while 1.26 trillion naira was paid out in 2025, showing a steady increase in funding. These disbursements are part of the Infrastructure Support Fund approved by President Bola Tinubu after the removal of petrol subsidy to support roads, agriculture, healthcare, education, power, water, and security. However, the records did not show how much each state received, raising transparency concerns. Civil society groups say despite the massive spending, insecurity and infrastructure gaps remain, questioning how well the funds are being used. And that's the big question Nigerians are still asking: where is the impact? The federal government is planning a major change in how electricity subsidies are paid in Nigeria, and this one affects every level of government. According to official budget documents, the federal government wants to deduct 3.6 trillion naira from the federation account between 2026 and 2028 to fund electricity subsidies. That's 1.2 trillion naira every year, taken before FAC money is shared among the federal government, states, and local governments. Why does this matter? Right now, electricity subsidies are mostly paid by the federal government alone, and the bills have been piling up. By the end of last year, total power sector debt is projected to hit 6.5 trillion naira, driven largely by unpaid subsidy obligations. So the government says no more hiding the bill. From 2026, electricity subsidies will be explicit, tracked, and shared across all tiers of government. In simple terms, once FAC revenue comes in, 1.2 trillion naira will be removed upfront and sent directly to MBET, the agency that buys power from generation companies and sells to discos at regulated tariffs. That means states and local government will now indirectly contribute to electricity subsidies, whether they like it or not. Budget Office officials say this move will improve transparency, reduce sector debt, and stop subsidies from turning into hidden liabilities. Energy experts also say it forces government to take electricity efficiency more seriously, from metering to monitoring real customers. Supporters argue it aligns with federalism, while critics warn governors may have less money for roads, schools, and hospitals. The main gist here is Nigeria isn't removing electricity subsidies yet, but it's changing who pays the bill, and from 2026, that bill gets shared by the entire federation. Nigeria's slowing inflation is not translating to more eating out for families. Restaurant and fast food visits dropped 28% last year as households turned to home cooking to stretch their budgets. That's according to ShopPoint Rewards Invisible Economy Report, which analyzed over 3 million shopping receipts, tracking 45 to 52 billion naira in consumer spending across 10 states. While prices rose an average of 23%, grocery spending stayed strong, making up 36% of all purchases, about 18.7 billion naira. The report shows families are protecting essentials while cutting discretionary spending. It also highlights how receipts reveal the real choices households make, from switching brands when prices spike to planning weekend shopping trips and consolidating purchases to save time and money. For restaurants and fast food outlets, the takeaway is clear. Even as inflation eases, recovery may be slow as Nigerians continue prioritizing value, essentials, and home-cooked meals. So, are you cooking at home or still hitting restaurants? Drop your thoughts below and let's chat. That's a Money Gist Top 5 at this time. I'm Oluwayemi Dada. For more business and policy updates, stay with Money Gist. Remember to like, subscribe, and turn on your notification bell. See you in the next video.